So the first chart that I'll show is a ratio chart between small, mid, micro cap stocks, that is SMID, against the large cap stocks. While the market was correcting in the first half of 2025, this ratio had dipped quite a bit, and that is why you were seeing a lot of selling in this particular space. But in the last 2 months, while large cap stocks have largely remained in the range, this ratio has further improved, suggesting that the market is broadening a bit. And it is important because whenever buying returns to SMID space, it always suggests stability in the market, and obviously sentiment wise also, because majority of retail traders are always in this particular segment. So this is one chart that tells you that there is a lot of improvement that is happening in the market. Lot needs to happen, but this is a positive sign. The next chart I'll put up is that of a 50 DMA pivot. Now this is 50 DMA, this is the closest pivot to it. So a 50 DMA pivot is a pivot that forms just below 50 DMA. In this particular case, it is these two pivots level, 22,400, 22,600. It acts as a trend confirmation indicator over medium term. 50 DMA can be violated many a times in a trend, but violation of pivot should never be ignored. This means in case Nifty keeps fluctuating above these levels, the trend would still be fine. But take note when these pivots get violated, because many a times what happens, whenever pivot violation happens, then trend actually accentuates on the downside. I'll just come to this part towards the end of the video because this is also important. On an average, market can be highly volatile around 50 DMA and yet not negate the overall trend. See, many a times 50 DMA gets violated, you will hear a lot of bearish commentary from traders, but it is important for you to understand that a trend can be valid as far as these pivot points hold. Also remember, if you've read books of William O'Neill, many a times he has taught that many times price comes closer to this pivot, violates it for a day or two, and then again trend resumes. Chart 10 is when I'll show you what may happen in the market. Now the next chart I'll put up is how many stocks are above the 200 DMA, that is daily moving average. Now why 200 DMA is important? Because when the correction was going on, or let's say in the larger part of 2024, around 70 to 75% stocks were always above 200 DMA. That gives broad term stability to a trend. If you look when the correction began in the month of September, October, this number started moving a lot lower. In March, only 248 stocks were above 200 DMA. This number now has again climbed to a number of 1,224, which roughly translates to 56% of all the stocks in the market. So this is again a crucial data point. Even after what has happened in the last couple of weeks, market has gone through a consolidation. This number is not coming down, which tells you again that the market is broadening a bit. It will remain volatile for plenty of reasons. But in general, the stability is definitely there in the market. I would want this number to sustain. At least 50% or more stocks need to be above 200 DMA all the time. If this number starts falling below 40, 30%, that is when you'll start seeing a lot of selling coming back even in large caps in the SMID space. The next chart I'll show you is the sector profile currently in the market. Now, sector profile is important because it tells you whether it is a pullback or a correction. Now, when market was correcting in the month of November to, let's say, March, there were a lot of sectors that were setting up, mainly first banks, finance, hotels, and hospitals. These were the primary sectors that were setting up between Jan to March. And then defense and capital market also started joining. And of course, these two sectors then did really, really well. Off late, you're seeing hotel space again gaining a lot of traction. Now, why this data is important? Because leave other sector aside and start tracking these sectors only. As of now, the sector leadership is intact. Sectors are still strong. We are just undergoing some kind of consolidation in defense, in capital market, in insurance space, in banks, finance, and also hospitals. So if this space also begins to crack, that is when you have to be a little conservative in the market and raise cash. Forget other sectors because they are not the leaders. In this particular cycle, these 6-7 pockets are leaders. Even chemicals is there, but I could not find a reliable index on the chemical sector. Chemical sector has a lot of various components. There were about 50 odd stocks, but I did not make an index out of it because of varied market cap. And there were a lot of overlap with other industries also. But broadly track these sectors and look for opportunities in these sectors only. Some of the sectors in this particular leadership have fallen a lot, have retraced a lot, have shaken out short-term players. It is the time for stronger hands or people interested in long-term trends to at least start nibbling a bit. Now, the next chart I'll open up is the chart of gold and silver, because these days you're seeing a lot of investment advice around these commodities or precious metals. See, gold and silver are great. Gold especially was a buy when the war actually began with Russia and Ukraine. For those of you who used to follow the channel back then, I had alerted about a mega trend happening in gold. For silver, now if you look at the chart of silver, silver is now moved above gold in terms of performance. I'll come back to this chart in a bit. Now, if you look at the next chart, this is gold, silver, and Nifty 500. This is year-to-date performance. If you look at the chart, silver is up 30%, gold is up 26%, and overall the market is up 2%. Probably this is the chart that is prompting a lot of people to advise people to take out some funds from equities and put it in gold and silver. I'll put up one more chart. Now, this is the chart of sectors, gold, and silver. If you look at this chart, the green line that you see is the performance of defense. This is capital market. This is silver. This is the hotel space, and this is gold. I've taken the stronger pockets here. Banks and finance would come somewhere here. So with respect to gold, over the last 3 months also, it is the sectors that are performing well. And by the time this chart ends later in the year, December 2025, you will see there will be either these pocket of sectors or some new sectors will emerge that will beat the performance of gold and silver. Currently, there is a lot of hype around precious metals, which is gold, silver. A lot of investment advice around this is being given. My personal take is in the very short term, both assets are a bit extended and they need a serious pullback. I would look at these assets again either to add or fresh allocation in silver only if it falls by 8 to 10%. Before that, I will not look at these sectors for, that is, these precious metals for fresh allocation. So gold and silver are great for diversification, but this space is overcrowded currently. When gold and silver are pegged along with sectors, sectors in general will always outperform. Don't forget this. Gold and silver can give stability to overall portfolio, but higher returns are generated through equities. In this case, sector-specific equities. That is, which sectors are doing well, and within those sectors, which are the stocks that are holding up and doing exceptionally well. The next chart that I'll show you is the template of stocks that are going to do very well. Again, these stocks belong to the strongest sectors in the market. All you have to do is check for rising 50 DMA. This is something I've repeated again and again. Volume should contract when the retracement is happening and then wait for a fresh candle to form, a strong candle to form around 50 DMA to take entry. There were some charts I had shared earlier also. Some of you could decode the names of those charts. I cannot put it up now. And look at where those stocks have gone. So this is a clear template you all have to follow. The template was stocks have to be above 50 DMA, 200 DMA. This is not my template. This is a template that has been taught by William O'Neill, by Mark Minervini, by Stan Weinstein. So when price sustains above 50 DMA, 200 DMA, the trend is stable. You have to look for stocks with rising relative strength, that is ratio against Nifty 500. Look for low volume retracement, just as we saw here. Look at how the volumes are drying up as the stock is moving lower. And price should be near all-time high, because as the price approaches left side resistance, it finds it difficult to cross it with ease. So always look for stocks that are closer to all-time high. And this is the template that you have to track. 50 DMA, the 200 DMA will be rising as well. Strong candles on the chart, strong volume. And then when the stock heads into consolidation, shakes out shorter time frame players, volumes have to contract. The next chart that I'm going to show you is US and the world market. This is for 2024. The blue line that you see is S&P 500. And this line that you see, this is the world ETF without US, that is ex-US. If you look in 2024, US massively outperformed the world. Now, if you look at this chart, there is a clear trend emerging wherein without the US, the world ETF is outperforming the US market by a huge margin. So this is a global trend. You have to keep this in mind because our analysis, when I say our analysis, majority of people want to look at what the US market is doing and they base their entire premise of the global market and their own market based on the structures of US market. This is fine. But what you have to keep in mind is that there is a move away happening from the US stock market into the emerging markets and other developed markets. That is, investors are looking into other markets actively. Moving away means diversifying money to other markets. It does not mean that the US market is going to fall a lot. Always remember the health of US market is critical to our markets and rest of the world markets. So a stable US market will pave the way for many assets to perform well. Decoupling does not mean we will rise if US falls sharply. This will not happen. And I firmly believe this. If the US market heads into a massive correction, there is no way India is going to escape. There is no way rest of the world is also going to escape. The best case scenario is that US slowly, gradually starts rising and the rest of the world does better. This chart is important in today's context because you see a lot of headlines that US is now at an all-time high again. And there is a lot of problem with bond yields. And eventually the US markets are going to fall a lot. This is not the true picture. It's not the true picture because this was true in 2024 because US was heavily owned by the world. Now it is exactly the opposite. Money is flowing into other markets. Case in point, our market is also getting funded because of this. While US is stable, it is the rest of the world that is outperforming the US. So keep this in mind because this is an important data point. Now, where do we head from here? This is a chart that I almost share in all of my videos. We are currently in an upward cycle. We will face a pullback, and then a clear, smooth trend is something I estimate only in the year 2026. I will slightly tweak this chart. This is the previous chart is 50 DMA. This chart is now 200 DMA, same index Nifty 500. Now, it is possible that we may retest 200 DMA again, form another base, consolidate, and then head higher. In this pullback, I don't know whether we are going to get it immediately or we will again move up and then move lower. That is something I don't know. It is very difficult to say. I remain very bullish on the market. I do have cash reserves, about 30% or more cash reserves I have as of today, I think 35%. And I will only invest that money when I get a deeper pullback. If with the current exposure market keeps heading higher, that is fine. That works with me. The remaining 30%, maybe I can use it through index or something else. But I will commit that money for the medium to long term only if I get a valid pullback. That valid pullback can be a correction of about 4-5%. It can be a retest of 50 DMA, breach of it. Basically, I want to buy, I want to allocate more whenever I see more fear on the street. So a breach of 50 DMA and the pivots could bring about more correction, but certainly the retest of 200 DMA and the breach of it would certainly cause a lot of discomfort in the market. And whenever there is discomfort in the market, only then you get attractive prices for the medium to long term. That is my current scale in strategy. You have to understand that if we head into a deeper pullback to something like a 200 DMA, then the strength pockets of the market is where I will focus again. Majority of my portfolio revolves around these sectors only. So if Nifty 500 were to go down and retest 50 DMA and breach it, perhaps the 50 DMA pivot also, and then move towards 200 DMA, then certainly these sectors are also going to fall a lot. And that is when I will make use of that pullback or a correction and then allocate more money to the winners. Because there is a rule in market that William O'Neill has taught that strength gets stronger and what is weak gets weaker. So it's always better to pay attention to stronger pockets in the market as opposed to the weaker pockets in the market. The odds of you finding a gem from the weaker pockets is much lower when you compare with the odds finding a strength pocket within the largest strength sectors that exist in the market. So this is my strategy per se when it comes to if we see a deeper kind of pullback in the market. Now, in terms of the BCG matrix, a correction is an excellent opportunity to review portfolio. See, BCG matrix is a research-oriented kind of matrix, but you can purely use it for sorting the best stocks in your portfolio and separating the best ones from the weaker ones. So the stocks in your portfolio that have risen the most and are consolidating now are the stars of your portfolio. Do not touch these stocks. These stocks can, yes, give away 5, 7, 8% easily to the market, but this is where you have to allocate more money. You have to identify which are the dogs of your portfolio. That is the stocks that are not doing well, that are already in negative territory. If the market starts moving below 50 DMAs, start cutting these positions out, try and free out some cash, and then pay attention to the stocks that are probably stars and the next stars in line where you can allocate more money. You will always in your portfolio have the future winners if you have done the right work about sector selection, about relative strength. You don't need to churn your portfolio too much, look for newer names. If you've done the work correctly, then already in your portfolio, some superstar stocks exist. Identify them as stars and question marks. Cut anything that is a cash cow, that is a slow growth, slow mover. Cut anything that is a dog which is not making you money. So this is how a correction or a pullback in the market gives amazing opportunity to get insights from your existing portfolio. And this is where you can easily identify which ones are the stocks that are going to do exceptionally well, that are holding out the pullback, the corrective phase, and which are the stocks that you have to completely exit, completely cut out in case the market starts deteriorating a lot in terms of breadth, in terms of pivot getting violated, and a deeper pullback to 200 DMA. If there is something important to speak about, then I'll make a video next week, else I'll see you one after that. So have a wonderful weekend ahead. Take care and be safe.